Hello, folks. Welcome to the State of the Market. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. We'll start with a few disclosures as usual. First down day, I think, in 10 sessions. It's pretty interesting. I'm going to include some links in the chat as well. Great to be with everyone. Today is Monday, May 5th, 2025. All right, I shared some links. Now, remember, you can go to tradestation.com, scroll down the page a little bit, and you will see a blog post that has a picture of an American and a Chinese flag. If you want to click on that, you can look at some of the main points we are going to be talking about today. I'm also going to show you the standardized returns of some of the ETFs that we're going to be talking about. Show these to you for a second. And then go to tradestation.com. I'll show you that in 1 second. This is TradeStation right here with the standardized returns of these ETFs. Okay, so if you're on tradestation.com, the main TradeStation page, go down the page and you'll see here stocks relieved on hopes of U.S. tariff talks. We're going to be discussing items in this blog post. We're going to be using the TradingView charts, but some of the points we're making are in this blog post. You might want to check that out. In fact, I'm going to take the chart and I'm going to just open it here so we can look at it as well. There we go. All right. Let's start off now, TradingView. All right, so for me, the big picture here is essentially that if the world doesn't end, if the tariff situation is resolved in some way, then people don't want to be in cash. I think that's essentially what we're looking at now in the overall market. So if we look, it's hard to really keep track of everything that's happening, right now in time. But if you look at the blog post here, basically the key thing is that there's optimism, obviously, that we're going to start to see improvement on the tariff front. And the thing is that tomorrow, the new Prime Minister of Canada, Mr. Carney, is going to be in Washington. We have some kind of sense that things are improving with China. Now, again, the market will run on optimism that might be unfounded. And but then the thing is, if it ends up being true, that's why people then have the idea you buy the rumor and you sell the news. Right now, the rumor is that we're going to have trade deals. Maybe we rally on that or we remain strong on that. And then when the trade deals come, we get sold. Who really knows? But I think the basic point right now is that there's a lot of optimism. And I think the key thing really is that there's really not a lot of leverage money on the long side. And there's a lot of cash that still seems to be on the sideline. A lot of people are insanely negative. And we're going to get to that. So I think one of the issues right now is that it simply is not a time when people are wanting to be selling. And I think that's really the most important thing now, is that the market consists of buyers or sellers, and if there's no sellers, you can keep prices, pretty healthy overall. I think also when we look at the economic data last week, the GDP was negative. You could call it stagflationary, but the key point is that we know it was caused by a huge amount of tariffs coming in, and those imports coming in. Now, those imports might actually be a net positive, because what it could mean is our economy is cushioned against trade disruptions, and we could actually be in a spot where all of the sort of problems that flows that results from shortages, tariff shortages and truck drivers losing their jobs and all these things that you can say are going to happen, they might not happen precisely because we imported so many things. All those imports cause a negative GDP print, and now those very same things, all those imports caused the negative GDP print. But then all those imports might actually now be the thing that prevent us from having shortages, prevent us from having inflation, and prevent the actual kind of damage occurring to the economy. And that might be where we are right now. And I think that the key thing is that the economy is staying alive. And the thing that's really interesting is if you look at earnings growth, the first quarter GDP now is back over 10%. It's one of the key things we want to mention here in our article, is that basically earnings growth now, according to FactSet, is at 12.8%. A week ago it was 10%, and the week before that was 7.2%. So if you roll the clock back 6 months ago, we were talking about the fact that there was expectations for double-digit earnings growth in Q1. We were supposed to enter a period of accelerated earnings growth. Then all the tariff stuff came along. and then all those earnings numbers came down. They went down to 1%. But now that the actual numbers are coming in, they're going back up again. So the problem is that we had a lot of fear, and the fear is not being validated. It's not panning out, and it creates a risk here of that wall of worry. And I think that's one of the things here that's important. Now, Scott Bessent was making positive comments at the Milken, some kind of Milken, and I think it's a Milken Institute. Sorry, but the key thing is that we had actually talked about this. If you look in our market trends webinars, if you look back 2 weeks ago, one of our key things, it wasn't this one, but if you look under the market trends, we do the market trends on Thursday afternoon at 2 p.m. Eastern. That's when we talk about more nuanced sort of stories. Has Scott Bessent taken charge? We said this back on April 24th. We noticed that Peter Navarro was less active and Scott Bessent was more active, and we have remained kind of in that spot now, which is something positive for the market. I think it's clear that the policies of Mr. Bessent are more favorable, more conventional for stock investors than the policies of Mr. Navarro. And I think that right now we're seeing the dominance of one versus the other. And that's also something that's keeping people kind of optimistic. We've also seen Mr. Bessent kind of win the fight for Jerome Powell. He's basically, according to the Wall Street Journal, he was basically saying, we have to keep Jerome Powell. And it seems like President Trump is following that. So these are things that give the market a degree of sort of hope. So I want to just point out, we did emphasize all of this in our in market trends. So our webinars on Thursdays and on Mondays, we cover all these things. So make sure you check them all out. All right, now in the actual when I talk about a wall of worry here, what's interesting is that if you look at the American Association of Individual Investors, we have been more than 50% negative for 10 straight weeks. That is the longest streak above 50% since the data began in 1987. So we're negative, 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 and not breaking lower, instead breaking higher. We've seen things like this before, and it's an interesting sort of pattern. But again, it shows that there's a lot of money on the sidelines. There's a lot of people absolutely convinced that we're headed for this sort of catastrophe. And then when that happens, when people are all piled in one direction, they're all in cash and they're all basically in the bomb shelters, that is when the market tends to, has that potential to run higher. And I think that's exactly the sort of situation that is happening now. And the other thing is you're in the bomb shelter and then the bomb doesn't fall. So that's what I mean. Look at the payrolls number. Look at earnings. The bomb is not falling. Instead, it's roses and sunshine up there. And I think that's really the sort of situation here. Earnings are beating. We're back to double-digit earnings growth. And payrolls are stronger than expected. We're not seeing the layoffs that the models say should be happening. The trucks aren't, allegedly the merchandise isn't moving. Apparently there's going to be shortages, but the truckers are not getting laid off. We're not seeing these problems happening. And that's what I mean. You go in the bomb shelter, you're so sure that it's going to be the end of the world, and then it doesn't happen. And that's more or less now the kind of thing that is underway, seems to be happening right now in the market. Now remember, we have a Fed meeting on Wednesday, and what's very interesting is if you actually look at the numbers from the CME FedWatch tool, we don't include it in this article, we mentioned it, is that now we're basically, people are pushing off from the idea of a June rate cut to July. So it's interesting, the market now is actually nudging that later. And I think that actually could be a positive, because if the Fed doesn't cut, if the Fed delays cutting rates, that's something that can stabilize the dollar. And if you stabilize the dollar, you kind of unwind that whole sell America trade, the idea of, dollars going to zero and stocks are going to zero and the whole world is going to buy gold. Well, then it basically reverses that trend. And I think right now we have to realize that we're in a spot where the dollar is starting to stabilize. We're going to get to that. So that's another thing that's kind of interesting here. But what is interesting to me is that we're starting to see, I want to just mention industrials. Look at last week, Carrier Global, Train Technologies, Howmate Aerospace. A bunch of industrials now are starting to perform. This is not what you see if you're going to have a recession. Financials are outperforming. There are a few of the sectors that we're going to get to here, like industrials, that are breaking these trend lines, industrials and financials. This is not what happens when people are worried about a recession. So something happened, and we talked about it a lot on this webinar at the time. back in November, December, we were talking about the crumbling of cyclicals, and it panned out. We were very wary of industrials throughout this entire period. And what's happening now is that period, we seem to have begun a period of being worried about an economic slowdown that actually started back in December. And we talked about it at the time. And now basically that is all played out. And now the market is swinging the other way. And the market seems to be looking forward to cyclicals, financials, industrials, small caps. Those are the areas now that are potentially starting to show some outperformance. And we're going to get to that. I think it's just interesting here. One of the things that's been very interesting when you look at a stock like Carrier is that basically there was a trade that didn't get that much attention, but it was basically data centers are being built. People need massive amounts of HVAC. There's capital, industrial stuff involved in these data centers. It's not just tech, it's an industrial trade as well. And those HVAC stocks have all reported strong earnings. Carrier and Train are two of them. So something is happening now when this data center, AI, industrial, HVAC theme is coming back. And that might turn into something for the utility stocks because that also fits into it. So we have the numbers from Microsoft and Meta with both talking about the data center spending. So we could be setting up here. Here's industrials. We're going to get to these, but it looks to me like we could be in a spot now where the market is refocusing. Okay, we had DeepSeek back whenever that was. I think that was back in January or something. There's this whole idea the data center thing is done. It's over. DeepSeek and blah, blah, blah. And then we have tariffs coming. All those things smashed up everything. But now we're at a spot where all of that seems to have passed. And we could be in a spot where now that we're seeing it in the HVAC stocks, now that we're seeing it in Microsoft, now that we're seeing it in Meta, now that we're seeing it in Seagate, which is also, now we're seeing it in Monolithic Power, MTWR, which does a bunch of this data center stuff. Now we're seeing it in Amphenol, APH, which does cables and stuff like that. The theme of the data center strength and the data center build seems to be coming out despite tariffs and all that. So the thing is remember, is that the tariffs are a huge headline distraction, all that stuff. There's secular trends under the surface. The secular trends took a pause for about 6 months, 2 quarters, which is probably a pretty standard, time, a standard interval. And now that secular theme is coming back. Okay. So industrials are very interesting. I want to just very also quickly mention we did a trading view idea on ADP, which is a payroll stock, and it's interesting because it's breaking this trend line. But another one that we've talked about a bunch that I really thought was interesting is Uber. I mean, to me, Uber is one here that's, believe it or not, it's an industrial stock. It's not a tech stock, it's a transportation stock. But we're starting to see this kind of broad sort of thing happen in industrials again. Uber is one we had talked about, and it's really interesting how it moves sideways. And if you look at its pullback in April when the market was totally freaked out, it couldn't even go below where it was in December. We had mentioned this period of sideways strength in the time when the market was bearish. That was actually a sign of relative strength. And now Uber advancing, it's an industrial. There's things happening in this sort of industrial space. Want to mention that. It's just what seems to be happening now. So I mentioned the dollar right now, dollar index holding, potentially inching higher. The VIX at this point in time is just kind of sitting around 20. It's interesting. I want to see what happens with gold here. Gold is kind of just sitting up here as well. But I mean, when you look at this, this is something that people might potentially see as the beginning of something of a fall, a kind of a channel headed down. And remember, if we head back to the world of normalcy and we're no longer in the world of capital flight from America and the global system ending and all that narrative, if we go back to normal, and that's always a thing when you get into this sort of like total fear narrative, the biggest risk after a while becomes going back to normal. And if that happens, something like gold might not really, that might be an area that gets, kind of hit. So that's important. Another thing I thought was just interesting right now, I'm going to get to these things. I want to just, it's interesting to see what's happening in energy. We've been talking about the weakness in energy. We've been talking about the fact that OPEC was flooding the world with oil. it's interesting to see the energy ETF really not having as much bearishness as it might. And why? I mean, to me, if we were talking recession, XLE right here would be probably pushing toward its lows. Instead, it refuses to break lower, even with crude. I mean, it was down 4% last night. Today, crude is down what, like 2%? So the fact is it even with OPEC flooding the world with oil, energy is refusing to break lower. That is also consistent with the idea of no recession. So we priced in this the whole recession thing. It all played out. The market priced it in. All that happened, and now the pendulum, based on the price action, could be swinging the other way. So that's the interesting thing I wanted to talk about before I jump over to the actual charts, which I will now do. S&P here, from my perspective, is interesting. This is really, this was the whole big week of the negativity on the tariffs. This candle right here, and in my view, here we're now kind of sitting right around, kind of, an area where people might look for this to pause, or potentially if we do have some volatility after the Fed. Excuse me. This might be it. Excuse me. I had a cough that you keep thinking it's gone and then it keeps sneaking back. Anyway, I want at this point when I look at the S&P itself, I don't actually see any a whole lot of clear signals. It's had a degree of rebound, and that might be a spot when the S&P itself essentially sits and doesn't give a lot of performance. Remember, in our volatility cycle, we talk about the market has a violent, coordinated, index-based rebound, and then we enter a period of stock picking and calm and lack of correlation. So now we're in a spot where the correlation is going to fade, and or at least it seems to be fading, and you're in that spot where the market is now less about the index, more about the individual stocks and the individual sectors, like we're going to get to industrials, financials, small caps, that sort of thing. So I wanted to mention that. I also want to point out historically, it's very interesting to look at this. This was all the way back from 2020, and what's here? Look at this rally we had. This was the pullback in the bear market of 2022. Look at how the market held exactly a 50% retracement of its low from basically, March of 2020, the COVID low, back to the high of November, December 2021. As the market pulled back in 2022, it held a 50% retracement. Now, if we look over here, we went down that bear market. Then in October of 22, we started climbing again. If you go from the low of October 22 to the high of February of this year, you can see that this most recent pullback came very close to a 50% retracement of that run. So I think that's kind of interesting. All right. There's a bunch of other points here. If you look in the article I wanted to mention, if you actually look at today's article, go down here to charting the market. We can see that the index has climbed for 9 straight sessions, okay, and that today is maybe a break of that, and it could just be, I mean, now we're only down 0.13%, so who knows? Maybe we'll turn green. That would be a long run. So it's interesting that we've had this price streak to the upside. The advanced decline line on Friday made a new all-time high. I don't see anyone else talking about that, but I saw it on TradeStation's award-winning platform. I saw it on TradingView, and I thought this was kind of interesting to see the S&P hitting the advanced decline line hitting a new all-time high. We have rising MACD. On the weekly chart, and we talk about this very often, this is the highest weekly close really since all the way back here, the first full week of March. It began on March 10th. This was the highest weekly close on the index. This close right here from Friday, it was the highest since this candle right here. So that's also an interesting sort of point, and also that's kind of consistent with lack of sellers and upward momentum. So we're back now essentially to this range right here, which this is basically the candle. So if we actually look here, I'm looking at the S&P now in the daily chart on TradingView. You can see here is we're basically back to the high of April 2nd. And so from my perspective, this is where look at the 10-day moving average. We're way above the 10-day simple moving average. So this could be a period here of just sideways movement as we kind of consolidate here. And I think that's important to realize. If the people who are looking for bearishness might look for weakness after the Fed. I mean, it is interesting to see that the expectations pointing toward less dovishness. So I'm not really sure at this point if really the Fed itself is what matters that much. I think at this point in time, it's really a focus on, hopefully some kind of trade deals and things like that. And don't forget, we do have floating out there in the ether. There are going to be some court decisions. There's going to be a preliminary hearing for the Liberty Justice Center on May 13th. And then there are going to probably be some other court events in May because I think 12, 15 states are suing about these tariffs, including California. And there could be some news on that as well. So we could have announcements from Trump and China and Canada and whatever, or we could have stuff from the courts, or we could have Scott Bessent just saying nice, happy things at events and things like that. So we are in that spot where other things can kind of trickle through. Now, getting back here to the key points, MACD is rising. The 21-day exponential moving average is rising. So most of the things are pointing toward still a bullish short-term sort of trend. So I did want to point out now, look at the dollar index very quickly, DXY, essentially here, it's holding this level from back in July of 2023. Now remember, it was very unusual to see this kind of craziness of the dollar index crashing as the S&P crashed. This is extremely unusual historically. It created this environment of capital flight and people selling America and all that sort of stuff. But the thing is again, that is a kind of extreme, kind of extreme negative story, extremely negative sort of, And so the thing is that extremes of fear are often sort of things that don't continue, and then the pendulum swings the other way. So what happens now if we essentially see we hold this level, and then what happens if maybe the dollar index can work its way back up? And that whole idea of selling America and all that stuff goes on the back burner for a while. And I think that might be something the dollar index is telling us here. We're not getting that confirmation of a breakdown to the downside. Okay, so that is essentially, so my point for the S&P here is we're basically drifting back to a level where we have essentially a zone in place between that first full week of March and essentially the high of the following week. And from my view here, this might be something where people sit and watch for a while. And then if there is that potential of some tests back down into this sort of zone, toward 5,500, but maybe not significantly below it. All right. Now look at the Qs, and in many ways, everything I just said at the S&P is absolutely true about the Qs. You can see essentially we have the same sort of price zone here. It's basically this is along the high of last week, and essentially the high back here the week begun March 10th. And you can see again, this is an area here where people might look for some sideways movement for a period of time. And in many ways, remember later in the month we have NVIDIA earnings. We seem to be in a spot here where the pendulum is swinging towards small caps. I'm going to show you that in 1 second. And that might actually result in something here where the NASDAQ pauses for a while and we see financials, industrials, and small caps, outperforming more. That might actually be the kind of trend that we start to see develop. I'm going to get to the small caps in a second. Now, the Dow is very much kind of showing what we're talking about here. This is more now value. The value theme is starting to kind of outperform. The equal weighted is starting to outperform. And that is kind of what you're seeing here with the Dow outperforming the NASDAQ. We have this falling trend line that we've broken above. We see the same thing in the XLF, the XLI. And so for me, this is kind of consistent with what that trend is going to be. Financials and industrials focus on the kind of smokestack economy, whatever you want to call it, the real economy, the non-tech economy, the cyclical economy. That's essentially here what this trend line is telling us. From my perspective, this is maybe the area where people look for the strength as the Qs and as the S&P market cap weighted main index kind of potentially sit and chop. This might be a place where people look for that near-term outperformance. Now, the Russell remains very interesting to me here because the Russell really here has, it's well below even its level from at the time of, it's still under the levels from the big tariff week right here, which is this week here. And I want to show you something else. Now look at RUT, divided by NDX, which you can do on trading. You can do it times 100 to give it a clearer sort of view. But if you look at this on a long-term sort of ratio, you can see that this was a level last July when the Russell exploded higher on a soft inflation number, and the Russell had this big rip. This is the long-term ratio, and you can see that this is really the all-time low. And so the thing is that people are looking for a potential area where the Russell might outperform. This would be the place to look for it. It has been in a downtrend, but also if we start to see this sort of return to financials, to M&A, to tax cuts, all those sort of things, this, you might say, oh yeah, it's in a downtrend, it's going to keep going down, but people might also see here the ratio of the Russell against the NASDAQ is actually now in a spot when it's showing stabilization, and people might actually be thinking this is more time when the Russell could outperform for a period of time, a few weeks, a quarter, something like that. So I think it's interesting to look at the Russell here and to realize that it remains, it never broke out to new highs, and I think right now people might actually look for this to have a degree of outperformance for a while. Not to say it's going to become the new market leader, as some strategists have said, but it's simply in a spot here where it has lagged for a long time. And if you expect things to be kind of, good for America and all that sort of stuff, and we have some M&A today with Skechers getting acquired, and that sort of theme, that is something that I think right here we are seeing in the Russell, and I did want to point that out because from my perspective here, the Russell here, people might look for more of a push up into some of these levels from back where we were, like in September and stuff. This one had the biggest pullback, and it might still be in a spot where it has a little, just a lack of sellers. All right, now the TNX, is the 10-year treasury, is to me interesting because it's basically totally neutral here. And one of the things I've said I think is important to realize is that I kind of see a new happy mix of things taking shape. And I would almost say maybe it's not new because it's more or less what I was talking about at the end of last year. Um, and it's one of the things that I think, despite the tariffs, remains out there. And so we've seen the thing with the AI boom continuing, the HVAC industrial thing continuing, but then we have earnings better than feared. But to me, what's really interesting is that oil going down is good for inflation. But I think we just have to realize the base effect of housing. There's a lot of anecdotal evidence now that houses are starting to transact and prices are coming down. And to me, that has a base effect that can kick in for all of inflation. And I think right now there is this scary, the idea of 10-year going to 6%. The United States can't finance its debt, blah, blah, blah. I mean, it's out there as a narrative. But what happens if the other thing happens? What happens if oil stays low? What happens if home prices start falling and rents start falling and then CPI goes to 2 or lower? It can potentially be happening. There's reasons to think it might be. And I think we have to realize here is that the TNX is very, at this point, it's totally stabilized. Scott Bessent put a big Band-Aid on it when he basically, back in early April, when he got Trump to undo some of those, to delay those tariffs and things like that. And I think we have to realize here is that we might be in a scenario here where the economic data with negative GDP and cheap oil and these things start turning into lower yields and lower rates. And if that happens, that could be a very important catalyst. And it could also be something that could help small caps. So just something to think about. Those, a falling rate environment would the way history has normally been, has favored small caps, industrials, financials, and it's been bad for mega caps. People sell the mega caps and they start buying everything else. Like we saw, look back to last July. So to me, this remains very interesting. I'm going to just zip through a few last things here. That's TNX. I mentioned DXY having some potential for a rebound. People can say, you know what, treasuries aren't so bad, the dollar isn't so bad, and that also could see this kind of unwind of the sell America trade. Now, materials here I was looking at, and to me, materials are, they have been. I mean, I don't see much with them that's very clear here. We have this falling trend line. They've not gotten above. Materials are just been a very messy sector overall, and it hasn't really been giving anything yet. Now, communications, of all the tech areas or the growth areas, this one remains potentially the strongest on the weekly chart. It's breaking this falling trend line, and this, to me, also, people might look for this to return to its old highs. maybe before you actually think. Now, energy here remains just kind of in this spot. We had talked about the potential for a pushback to the downside. From my perspective, this does remain, something with risk to the downside here. But maybe when the market does want to have some kind of pullback, or at a certain point in time, energy still has that potential for move down towards 75, the XLE. We've talked a lot about the fact that this does have that problem with OPEC. And from my perspective, this is something that does still have downside. If you look at it, this might be something with the lower weekly high here. People might see this as something that has that risk, but at this time, people seem to be focusing on cyclical growth, and it might not really want to come together for a little bit. XLF is also breaking this falling trend line. We talked about how the financials were staying above their January low. We had mentioned that, and it basically has just been plowing higher, and this is also very much consistent now with an index that potentially people might look for continuation to the highs. Industrials here breaking this trend line, and again, now that this thing is moving again, people might look for a continuation toward the old highs. And I think this has been pretty interesting to look what's happening in industrials here. Now, technology here. I think that the AI thing is intact. It's been interesting to see what's happening with Microsoft. But then there's some other companies like VRT, which had strong earnings. Seagate, these are also those kind of hardware names. So from my perspective here, the one problem with XLK is that Apple is kind of a wounded animal. If you look at it, technically here and the fundamentals on it. So I think that's something to bear in mind. But again, here it's interesting to see that the tech, it has this resistance zone across here, but the underlying story with Microsoft and these things in hardware seem to remain intact. Okay, that's XLK. XLP is just totally neutral, drifting sideways. People might see some downside risk here simply based on if sentiment gets better, that could actually be a negative for consumer staples. Real estate here is also kind of in a resistance zone, and this might be something here that to wait for some kind of clarity and to see if maybe we do have a breakout to new highs here. And otherwise, this is potentially just like a very frustrating sort of drift here. It has this potential resistance, but from my perspective, this is something people might want to really wait and have some kind of more clarity on that rates are going to go down significantly. This might be something that when we get to the point when we know that we're really at the verge of a Fed rate cut, this could perform. And until then, it might just be like hitting your head against the wall. Utilities, XLU. Now, what's very interesting to me is that if you look at the XLU here, it's near the top of its range. But the thing is, this fits into that data center theme. And utilities have emerged as this unexpected growth story. People, I mean, this might be something that could break out after the Fed this week. And I think we got to realize here, this has basically gone sideways since last August. It's been pretty interesting. And if the Fed, just simply because the Fed has their meeting, might be the catalyst for this. So I want to point that out. This is something here that might be getting ready for a breakout. XLV, that was the utilities XLU, but now we're looking at XLV healthcare. For me, this is an area here where people might view this as a lower high emerging with potential for continuation down to, the recent lows are potentially lower. It's interesting that, some of these medical device makers seem to be kind of sensitive to tariffs as well. Like Zimmer today, ZBH had some bad news based on tariffs. There were some others. So I want to just kind of point that out and just mention that this is also a kind of safe haven that maybe isn't so safe right now. And it seems to have some real issues. XLY, from my perspective here, the problem with XLY is Tesla. If you actually look at the daily chart of Tesla, you basically have this resistance area right around like 290 that it keeps stuck at in the 200-day death cross, all that sort of stuff. And then, fundamentals that might not be that good. And so I think right now that's a problem for XLY. Amazon, kind of a sloppy quarter. And then you have other things like the cruise ships and a lot of these travel names and things that seem to be struggling at this point in time, and they could have issues. Travel is going to be has had a lot of negative news recently. So I did kind of want to point that out here. This could be one here that's also kind of dead money. And from my perspective, the things people might be looking for are communications, financials, industrials, and small caps as the potential areas of strength. Technology, potentially, XLK overall, potentially continuing, but then things like consumer discretionary, consumer staples, energy as being areas that are potentially more laggards. All right, I got to go. I'll see you guys on Thursday at 2 p.m. Eastern. Have a great day, and I'll see you then. Thanks for watching.